You see it on your screen. A stock with a 10% dividend yield. The math is simple. 10%. That's a huge cash return. It feels like you found a secret, a glitch in the system that everyone else missed. But this is where one of the biggest traps in investing appears. That number, it's rarely a gift. More often than not, it's a flare shot into the sky, warning of trouble below. An exceptionally high yield is often a sign of deep distress. So let's break down why. A dividend yield isn't just about how much a company pays you. It's a fraction. The annual dividend payment is the number on top, and the share price is the number on the bottom. When that yield soars into the stratosphere, it's almost never because the company suddenly got generous and jacked up the payout. It's because the bottom fell out. The share price is cratering. And when a stock price drops that sharply, the market is sending an unmistakable message. It's saying it doubts the company's future. It doubts the strength of the business, and it really doubts the company's ability to keep making that payment. History is crystal clear on this. The higher the yield, the higher the statistical probability of a future dividend cut. So where's the line in the sand? When does a healthy yield turn into a risky one? Decades of market research across different countries and different eras point to the same pattern. Up to about 5 or 6% yield, you're in relatively safe territory. It's a normal level of risk. But once you cross that 6% threshold, the probability of a dividend cut starts to rise meaningfully. From 7 to 8%, the risk becomes officially elevated. And when you hit 9, 10% or more, you've entered what analysts call distressed yield territory. Historically, the cut rates for companies in this zone are brutally high. You almost never get a top-tier, high-quality company paying a double-digit yield. But, and this is crucial, a high yield signals higher risk, not a guaranteed disaster. Markets are not perfectly rational machines. They're driven by fear and greed, and they overreact all the time. Sometimes a perfectly solid company is just under temporary pressure.
Maybe sentiment collapsed too quickly, or an entire sector like energy or banking hits a cyclical downturn. And in those moments of panic, some of the best long-term buying opportunities are born. A high yield can represent a true bargain or a true danger. The entire game is about figuring out which one it is. And these yields don't exist in a vacuum. They breathe with the market cycle. When stocks have been climbing for years in a late-stage bull market, prices are high, which means yields get compressed to low levels. But after a big correction, a real bear market sell-off, prices fall and yields rise sharply across the board. Those are the rare moments when investors can buy high-quality companies at temporarily elevated yields. The key question isn't, is the yield high? It's, is the underlying business still fundamentally sound? This all leads to the single most important rule in this kind of investing. Quality beats yield. Every single time. Many investors repeat the same mistake, chasing the highest number they can find while ignoring the health of the company writing the check. But long-term success doesn't come from a flashy 12% yield that gets cut to zero next year. It comes from companies that deliver stable cash flows, disciplined payouts, and a long history of consistent dividend growth. Most of these reliable workhorses historically sit in the 3 to 5.5% range. Anything far above that demands a closer look and a healthy dose of skepticism. A dividend yield becomes too high when it stops signaling income strength and starts signaling business stress. The challenge, and the real edge, is learning to distinguish between legitimate value that the market has overlooked and a yield trap that's about to spring.